Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Petco stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a small cap company, 740 million market cap. They're trading at $2.69 a share, and they have 276 million shares outstanding. Petco is a pet retail store. They sell food, products like leashes. They offer services. You can get your pet groomed. You could even buy a new pet there. They were founded in 1965, headquartered in San Diego, California. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow was pretty good in 2022, 119 million. Pretty low margins, only 2%. It dropped to 68 million in 2023. Then it's been negative since then. Net income is the profit or loss on the income statement. It's revenue minus expenses. Similar trend, positive in 21 and 22, a really big negative in 2024. They must have had an asset impairment, and then a smaller negative in the trailing 12 months. Revenue is a sales for the company, and that goes up a little bit from 5.8 billion to 6.2 billion. It actually went down when you compare 2024 to the trailing 12 months. We estimated 4 years of future free cash flows. We also estimated a terminal value to all cash flows past year 4, that's 1.2 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1 billion. We divide that by 276 million shares. And we get a calculated stock price of $3.80. They're trading at $2.69, so they're trading at a 29% discount. It's a buy according to the model. There are 45 companies in the same industry as Petco, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend too much in CapEx, 139 million, which is less than the median average. AutoZone spends the most, 1.1 billion. When these companies open up a new store, the cost to buy the real estate, that's CapEx. Also, equipment that goes into the store is also CapEx. They're pretty leveraged, debt to equity ratio of 2.7. For every dollar of equity, $2.70 of debt. GameStop is the best at 0.1. They don't pay a dividend. Negative free cash flow. They rank 21st in market cap, much lower than the median average. They have the best price to book. They're trading below book value. We can't look at that PE or price to free cash flow. They have the best price of sales. It's 0.1. That means their market cap is 10% of their revenue. Revenue 6.2 billion. That's pretty close to Williams-Sonoma. Williams-Sonoma is only 7.5 billion. But Williams-Sonoma is about 30x the size. This stock has moved around a lot. The 52-week low was $1.50. The 52-week high was $5.77. So it's a pretty wide range. If you put $10,000 into this company when they started trading, you would have lost over 90% of your investment at $900 today, a 91% loss. To summarize, I have them trading at a 29% discount, ranking 6 out of 10. I might buy it short term and long term. 6 out of 10 short term, 7 out of 10 long term. It seems like it's pretty undervalued, but the company has struggled a lot. Plenty of people think they're going to go out of business. That's why the stock has gone down over 90%. Ratio is 5 out of 10. Really good price to book, price to sales. We can't look at that PE or price to free cash flow. Financials are a bit weak. They have negative free cash flow, and revenue isn't going up too much, only 7% since 2022, not even beating inflation. Let's take a look at their latest income statement. Here's the 3 months ending 10/28/2023, the 3 months ending 11/2/2024. And these two columns are the trailing 9 months. So revenue is up very slightly from 1.5 billion to a little over 1.5 billion. So not much growth. Product sales went up a little bit, so did services. Product sales 1.26 billion, services a $250 million. Let's see if they give a different breakdown of the revenue. Almost exactly half their revenue is consumables. That would include pet food and treats. Supplies $500 million, services a $250 million. Consumables and services are up. Supplies are down. Supplies went from 525 million to 510 million. In this chart, they give percentages. Consumables up 2.7%, supplies down 2.8%, services up 5%. For the trailing 9 months, a similar trend. Up in consumables, down in supplies, up in services. Total revenue when you compare this quarter to this quarter, is up 1.2%. They mention a little bit down here, we continue to experience momentum in consumables and services, although we have also experienced a decrease in supplies and companion animal sales, driven by softening in discretionary spend associated with the current macroeconomic environment. Lots of big words. Below revenue is cost of revenue. Cost of product $780 million. Revenue $1.26 billion. So decent margins. For services, the expense is $150 million on revenue of $250 million. Total cost of revenue $936 million. They give percentages down here. Their gross profit margin is 38%, since cost of revenue is 62% of their revenue, which is up from last year. Last year was under 37%, so they're more profitable, they're more efficient. But most of their gross profit is spent in SG&A, nearly 38%. I'll show you up here. SG&A is almost equal to gross profit, so their operating income is positive $4 million. Last year was negative $1.2 billion because they had a goodwill impairment. That's when you write down the value of an asset on your balance sheet and pass through the loss onto your income statement. So you could probably ignore this $1.2 billion. That's accounting. So they should have had a $10 million net loss if you strip that out. They received $1.3 million of interest on their investments. They spent $36 million of interest on their debt, so they have a lot of debt. So their net loss is $17 million. Last year, $1.2 billion. Let's look at their balance sheet. Current assets, $930 million. Current liabilities, $1.1 billion. So their current ratio is below 1, which means they may need to add debt to get through the next 12 months. They have a lot of inventory, nearly $700 million. That's most of their current assets. Because if you go into a store, there's a ton of inventory on the shelf. Everything in the store is inventory until it's sold. Then you have inventory in the back room as well. Fixed assets, $2.2 billion. That's the cost of their stores and things inside their stores. Operating lease right-of-use assets, $1.3 billion. These are assets they lease from another company. Nearly $1 billion of goodwill, $1 billion of trade names. Goodwill and trade names are from acquisitions. So total assets, $5.2 billion. Total liabilities, $4.1 billion. Their biggest liability is $1.5 billion of senior secured credit facilities. Their next biggest is operating lease liabilities, $1 billion. This is how much money they owe on these assets, these right-of-use assets. Assets minus liabilities equals equity, $1.1 billion of equity. They raised $2.2 billion from selling their business. They lost $1.1 billion from running their business. Accumulated deficit is the sum of all their prior net incomes, minus the sum of the dividends they paid out. So historically, they're not very profitable. Let's go down to the statement of cash flows. You want to track cash. Because remember, they had a big net loss of $1.25 billion, but they generate a positive cash flow. Because when you look at the income statement, they had a huge loss. This year, a small loss of $88 million. But this year, they generated less cash, half the amount of cash as last year. So that's why you have to look at the statement of cash flows. Because that big asset impairment is an accounting item. It doesn't affect cash. So you have to add that $1.2 billion back. The cash occurred many years ago when they acquired the company. It's like if you buy a house, say in the year 2015, and you spent $200,000 on the house. Let's just say you paid all cash. This year, you sell the house for $150,000. So you actually lost $50,000 on that sale because you paid $200,000 10 years ago. But in 2025, when you sell the house, you receive $150,000 in cash. You don't pay $50,000. The cash happened 10 years ago when you bought the house. That's exactly what happens here. This $1.2 billion occurred when they bought the company. It could have been 5, 10, 20, 30 years ago. But now they're just writing down the value on the balance sheet. They're not actually selling the company. They can't sell it because the company they acquired is absorbed into their company. Let's look at the investing section. They spent $91 million of CapEx. They call it fixed assets. Last year, double that. And they spent a small amount in acquisitions. In their financing section, they added $200 million of debt. They added that debt to pay down older debt. Let's look at a company on Simply Wall Street. Its last price, $258, $700 million market cap, down 4% in the past week, down 3% in the past year. It looks like they started trading in the beginning of 2021. And that was pretty much its peak. It started out at 25. That was in January or February. A few months later, its highest ever, 28. It never got that high again. So June 2021 was the peak, nearly 4 years ago. And then it went up and down, but in a downward trend. And you could see it went all the way down to 926 in mid-2023, which is a pretty big drop, but then it dropped a good amount more. It dropped real fast over the next few months, down about 65% from July to October 2023, trading at $4 a share. So since the end of 2023, which is about a year and a half ago, it pretty much traded sideways. It did come down to 156, but then back up to about $5. Now it's coming back down again. So now it's trading between $2 and $3. Simply Wall Street thinks the stock is worth 27 cents, 840% overvalued. 11 analysts priced this stock at $4.57. They think it's undervalued. In 2019, their debt was $3.3 billion. It peaked at $4.8 billion. That's right in the beginning of COVID. They paid down a lot of debt. They brought it down to $1.7 billion. It's been pretty steady since then. It's currently about $1.6 billion. Equity was a lot lower than their debt in 2019 and 2020. Then equity got a little higher. Now it's back down to a little lower. Equity of $1.1 billion. And not much cash, only $118 million of cash. The minimum cash should be 5% of the debt because you assume a 5% interest rate. So 10% of 1.6 billion is 160 million. Half of 160 million is 80 million, so they're above 80 million. So they have enough cash to service the debt. In the past year, one insider buy, a lot of shares, 750,000 shares. 63% of the company is owned by private businesses, 35% by institutions, and 1.5% by insiders. I think Scooby Aggregator is a private equity firm. They own 2/3 of the company. The next biggest shareholder is BlackRock, 3.5%, then Vanguard. Dimensional Fund, 1.18%, Geode, 0.8%, UBS, 0.6%, AQR, 0.4%. Their employee count has gone up from 23,000 to 29,000. And the ticker trades on the NASDAQ, Mexican Bolsa, Bursa Stuttgart, and Deutsche Börse. So if you want to copy my discounted cash flow model, click on the video in the top right corner.